Okay, now you're probably watching this because someone may have told you that you can save significantly on taxes using short-term rentals. If that's why you're here, you're in the right place. If we have not met, I'm Chia Gazie-Fawale. I am a pediatric anesthesiologist, and I love to chat about real estate, short-term rentals, all that fun stuff. And I like to share basically what we found and what my clients have actually done with short-term rentals, totally above ground, totally in the IRS code. Now, listen, I am not an accountant. Okay, and I don't pretend to be one on TV or YouTube or a podcast or any of that. I literally just share so that you know questions that you can then go ask your own accountant who is STR savvy, short-term rental savvy. Now, I always qualify what kind of accountant to ask, because what I've found is that I've had some clients go talk to their accountant and they say something like, oh, you're going to get audited, you're going to get this, you're going to get that. And then I talk to the other accountants and they're like, oh yeah, that's totally normal. Oh yeah, so pick the person that you talk to, okay? Pick who you talk to. All right, so let's get right into it. Now, if this is the first time that you're hearing about this, you're probably thinking, wait, Chia Gazie, what are you talking about? What's this whole thing about short-term rentals and saving on taxes? Like, I heard about it from a friend of a friend. Like, can you break it down for me? I got you, boo. I got you. Okay, so this is what goes on with short-term rentals. Now, let's kind of rewind a little bit. When I started investing in real estate, one of the things that actually made me choose to invest in real estate was when I realized that there was this thing that you got when you bought a property called depreciation. Depreciation is this concept built into the tax code that allows investors buy a property and then get a portion of the value of the property subtracted from their income every year they own that property. Basically, the government having a way of saying, we know that properties left on their own shrivel into dust over a period of time. If you have a property that you don't go to, you don't visit, you basically abandon, come back in 10 years and that property will be like mush, okay? So the government basically gives you a negative number every single year to account for the fact that you're keeping up the property in the form of depreciation, okay? Now, normal depreciation, straight line depreciation, will basically take the value of the property, subtract the value of the land, because land does not depreciate, okay? And now whatever is left, they'll divide that by either 27.5 or 39. 27.5 for residential property and 39 years for commercial property. Short-term rentals happen to fall under commercial property. So as an example, you get the property for $500,000, assume the land is worth $50,000, $450,000 is what's left when you remove the land. 450 divided by 39 gives you about $11,000. So using straight line depreciation alone, you get, after all your income, your expense, and all of that, whenever you have your profit, you can also subtract $11,000. Basically, you get to shelter $11,000 every single year, and you own that property for the next 39 years. However, if all you got was an $11,000 tax shelter, I won't be having this conversation. Back in 2017, in the Tax Cuts and Jobs Act of 2017, something called bonus depreciation was beefed up to allow investors to basically depreciate more in the first year of operating the property. What does this mean? This means that the government basically said, okay, there are items in the property that although the property gets depreciated over 39 years, okay, we know that not every item in that property will last 39 years. We know that some things like your cabinets, your flooring, your carpet, your light switch, all those things, they wouldn't last 39 years, okay? So what happens is an engineer or cost segregation specialist comes out and does what's called a cost segregation study. And with that cost segregation study, determines which items in the property will not last 39 years and puts them into different class lives. Now, anything that falls under less than 20-year class life, anything that's based on the IRS rules will not last up to 20 years. With the Tax Cuts and Jobs Act, you could take all of that in the first year between 2017 and 2022, okay? So you could take 100% of the monetary value based on the cost segregation study of anything that will last 20 years or less. After 2022, that began to phase out down to zero. With 2023, 80% of that number, 2024, 60% of that number, 2025, 40, 2026, 20, just like that, all the way down to 0. Okay, so now as of the time of this recording, we're at 60%. So let's say that out of that $450,000 in my earlier example, the cost segregation folks determined that $159,000 or $160,000 of that was 20 years or less, in the category that was 20 years or less. So let's say 15-year or 5-year class life. Okay, that means that you will now have in the first year, as of 2022, you would have had in the first year a negative number on your taxes of $160,000. This means that you would have sheltered $160,000 from your taxes as of 2022. Okay, well, we can't go back in time right now, as of right now, okay? So as of 2024, you can now take the 160 and multiply that by 0.6, okay? So 160 times 0.6. That's now $96,000 that you can keep on your tax returns as a negative number. So that means that if you have, let's say, for example, that you earn $200,000, okay? That's your income. You now have $96,000 as a tax shelter. That means that all you will have to pay taxes on will be $104,000. Now, I would rather pay taxes on $104,000 than on $200,000. Anybody with me? Say aye. So just type aye in the comments, okay? If that's you. So the question then, the next question is, okay, but hold on. I understand that with rental property, you have to be a real estate professional to use the tax deductions, to use bonus depreciation. And that is true with rental property, with traditional rental property. Why do I say that? Because the IRS specifies that if a property is rented for 7 days or less, it does not constitute a rental activity. So normally all rental activity is passive, but if a property is rented for an average of 7 days or less, then it does not constitute a rental activity. So the next key point with using the short-term rental tax strategy is to operate it as a short-term rental. Because when you operate it as a short-term rental, then you no longer need to meet real estate professional status to be able to use that $96,000 tax shelter against your W-2 income. So a number of you who may have owned long-term rentals may have said, well, I need to become a real estate professional. And there are a whole list of requirements for real estate professional status. Short-term rentals, you don't need to do that because the first thing in the IRS thing basically is that if a property is rented for 7 days on average or less, then it doesn't constitute a rental activity. Now, I'm going to remind you, I am not an accountant, but I've read it. Okay, so it's in English. Okay, so go find an accountant who is savvy with real estate activities or real estate issues, right? And go talk to them. Okay, I have a number of videos on this same platform where, we have had accountants basically come and talk about the same thing. So you can go find the one with Brandon Hall or even Amanda Hahn. Okay, and I'm basically summarizing what they'll tell you. So number one, buy a property and operate it as a short-term rental. Have your guests staying an average of 7 days or less. Now, does this mean you can't take a guest staying for 28 days? You can, but just make sure that at the end of the day, the average for that year is 7 days or less. You can do averages, right? Yes, you can. Yes, you can. Okay, so number two is that you now want to make sure that you have moved the income from the passive bucket into the active bucket, okay? Now, if you have a business that you own with someone and you are passive in the business, it is still considered passive income, and passive losses only offset passive income. So you want to make sure that you're able to show that you are active in the business of the short-term rental. How do we show this? It's called material participation. And the government has a requirement that to show that you are active in your short-term rental business, you need to materially participate in its operations and prove a number of requirements. One of the most common tests that people in our community use is the 100 hours and more than anybody else. So that means that you are spending 100 hours working on the property, and you're also showing that no other person is spending more than 100 hours on that property. So this means you have any housekeepers, you have any, handymen, you log their hours and that they should not surpass your time. okay? So that you spend at least 100 hours and you also are more than anybody else. So if you have somebody spending 120 hours, well, you better have 122, right? 121. Like, you need to show that you are spending more time than anybody else on that property, and that the time that you spent is at least 100 hours. So that's the first one. Another common one is the 500 hours without regard to anybody else. So let's say you have multiple properties and you're able to log, because if you're operating a short-term rental and you are spending 500 hours on one property, please go do something else, okay? Okay, so the 500-hour test will most likely be applicable if you have multiple properties. This year, actually, that's what we are shooting for, because we've had multiple properties go live this year. And so you want to make sure that if you have 500 hours, then it doesn't matter how much time anybody else spent on the property. There are other tests. There's a third test that basically says that you are doing all the work on the property. So let's say you buy the property, you close in December, you don't have enough time to get to 100 hours. Well, you need to at least show that it's only you working on the property to prove that you are materially participating in this activity. And there are a lot more, but these I think are the most common that people in our community use. Okay, so we've done number one. We bought the property and we operate it as a short-term rental. In other words, the guests are staying for 7 days on average or less. Number two, we materially participate, which means that we record the time we spend on the property. And we're spending 100 hours and more than anybody else, which means that we're logging other people's hours unless we're trying to go, to the 500-hour option. Now, the third thing to make this all make sense is now what I mentioned at the beginning of this, which was to do the cost segregation study and get your bonus depreciation, okay? Now, when you do this and you have taken care of these three things, you take all of it and present it to your short-term rental savvy accountant. Now, one thing that I find is that some accountants just aren't familiar with this, and there's nothing wrong if they're not familiar with it. Like, for example, I'm an anesthesiologist, okay? And sometimes people will come to me asking dermatology questions. And I look at them like, right? Because I haven't done dermatology since medical school. Medical school was like before 12 years ago. I graduated from medical school 12 years ago. Life has transformed, and I'm sure medicine has too. In those 12 years, you do not want me diagnosing your skin condition, trust me. Or your heart. Okay, so yes, I look at EKGs every single day, but when it comes to like actual cardiology questions, like cardiac type questions, you want a cardiologist looking at that, okay? So the same thing. Some accountants aren't as familiar with real estate. Some may do real estate, but maybe mixing it up when it comes to like short-term rentals. So make sure you find one that actually understands short-term rentals. In my case, actually, I basically took a training to my accountant and I was like, here, watch this. I don't recommend you do the same thing, okay? But after I sent it to him, the next time that I called him back, I guess he had then done his background research and was able to get it. And that first year, from one property, we were able to get back a tax refund of $30,000 from just one property that we bought that year. So this is basically the short-term rental tax strategy in a nutshell. It's actually pretty powerful. I had a client who in 1 year got back $170,000 as a tax return, okay, by applying this very simple strategy. It is not like, this is not like pretending. It's not anything shady. It's not anything to be queasy about. It is literally just stuff that's built into the tax code to help the government get people to do what it actually wants people to do: operate businesses and buy real estate, right? Okay, so anyway, if you got any value from this, then make sure that you hit the like button, share, and subscribe so that you get even more notifications about this. Let somebody else know. Share this with like another, professional in your life. Is that you have doctors, you have, other professionals in your life that are paying high taxes, okay? Do them a favor. Save their wallets, people. All right? And I hope you found value from this. See you on the next one. Take care.